These items are computed on a consolidated basis, meaning that each separate item from each individual member of the affiliated group is added together, and then all the limits are applied on the combined group's income. So charitable contributions, that 10% limit is going to be based on consolidated adjusted taxable income. The 1231 gains or losses, so the group members' 1231 gains and losses are netted together rather than netting the gains and losses for each member separately. The dividends received deduction, that limit is calculated based on a consolidated basis for dividends received from corporations outside the group. Dividends received by one group member from another are eliminated. And then there's no dividends received deduction for them. It's treated as an intercompany transaction. The regular tax liability is calculated based on the consolidated group. They apply the Section 11 corporate tax rates to determine their tax liability. And then the credit the tax group can claim in the current year is limited to the excess of the group's consolidated net tax over 25% of its consolidated net tax exceeding $25,000. The net tax is the regular tax reduced by certain credits. And then for tax credits, the limitations on the general business credit and foreign tax credit are determined on a consolidated basis. And for estimated tax payments, the consolidated group determines their estimated tax payments on a consolidated basis. There is an exception, though, for the first 2 years. Net operating losses are also computed on a consolidated basis. And then for 2018 and later, they carry forward indefinitely, but they are limited to that 80% limit. And that 80% limit is calculated based on the consolidated taxable income. If a corporation departs the group, though, between the year the consolidated net operating loss arises and the carryover year, the group determines the portion of the net operating loss that carries to the departing corporation's separate return year. So if the corporation leaves before the net operating loss can be used up by the consolidated group, the departing corporation gets to take a portion of the net operating loss with it to carry forward on its own individual return. For current year net operating losses, each member's separate taxable income is combined to determine the combined taxable income before any adjustment is made for net operating loss carryovers. Only the consolidated net operating loss carries over. And then for carryforwards and carrybacks, when members of the consolidated group are not the same in the carryback or carryforward period, an apportionment is made. So we divide up the net operating loss. The consolidated net operating loss is apportioned to each corporation that was both a member of the consolidated group and incurred a separate net operating loss during the year. So they allocate the net operating loss basically to those who produced it. And this is the formula. This is the formula that's used when the composition of the group changes. So you can see the fraction, the separate net operating loss of the particular group member divided by all the net operating losses of the group members having losses. This is an important distinction. So it's not the income of every member of the group. It's the net operating loss of every member of the group that had a net operating loss. So we take the separate net operating loss divided by the total of the net operating losses times the consolidated net operating loss. And that's going to give me the portion of the consolidated net operating loss attributable to the particular group member. So net operating loss limitations, it's also limited by the special return limit year rules. So these rules prevent abuse, and to do that, corporations that bring net operating losses into the group, so they have had carry forwards from previous years, they bring that net operating loss into the consolidated group from a separate return year, they're going to have limitations on when and how they can use those net operating losses. The consolidated group can only use the net operating loss to the extent the joining group member contributes positively to the net income of the affiliated group. So here's an example. Corporation A enters the consolidated group in 2018 and brings with it a $20,000 net operating loss. This occurred in a separate return year. The consolidated group cannot use that net operating loss unless and until A has a positive taxable income, so makes positive contributions to the consolidated group's income. And then all other net operating rules and limitations still apply. So this is in addition to those rules. Separate return year limitations do not apply to a separate return of the parent. So a parent can use the net operating losses, or the separate return year of the corporation that was a member of an affiliated group but just elected to file a separate return. So if we were all members of the same group and we just didn't file a consolidated return, we can use those net operating losses. Wildcat and Badger corporations have filed consolidated tax returns for several years. Early in the current year, Wildcat purchases Hawkeye, a startup business that incurred net operating losses in each of its first 3 years prior to the purchase. Hawkeye's losses total $260,000. Can the Wildcat Badger Hawkeye Group deduct the losses on its consolidated tax return? The group expects annual profits to be $300,000, with Hawkeye's contribution to the total being $50,000. What tax issues should the 3 corporations consider when determining how they can deduct the net operating losses? Okay, so the separate return year limitations will apply because the Hawkeye Corporation brings $260,000 of net operating losses that happened in a separate return year. So those can't be used until Hawkeye positively contributes to the consolidated taxable income. Here it says the group expects profits of $300,000, Hawkeye's contribution being $50,000. So if those predictions are right, those projections are right, it looks like they can use $50,000 of the $260,000 net operating loss. Now, all the other net operating loss limits will apply as well. So here is the answer. Hawkeye's $260,000 of losses or separate return loss year losses. Because Hawkeye was not affiliated, consequently, the net operating loss use is subject to those limitations, assuming the overlap rule does not apply because Wildcat's acquisition of Hawkeye does not trigger the Section 382 limitation. The group's use is limited to the lesser of Wildcat's contribution to consolidated taxable income, so that is $50,000 if their estimation holds true. 80% of consolidated taxable income computed without regard to the net operating loss. And that's just our normal limitations on using net operating losses. So this is nothing different between an affiliated group and just a normal corporation. Or 3, the unused net operating loss. If the group's profits expectations are accurate, the group's annual use of the net operating loss will be limited to the lesser of $50,000, which remember that was Hawkeye's contribution, $240,000, which is that 80% of the taxable income without regard to the net operating loss, or 3, the unused net operating loss, which was $260,000. So assuming all those projections are right, they'll be able to use $50,000 of that net operating loss and then carry the rest forward for 5 years. P Corporation acquires all of S Corporation's stock on January 1 of year 2. In year 1, the corporations were unrelated entities that filed separate returns. P and S reported the following results. Ignore the Section 382 loss limitation that might apply to P's acquisition of S. Assume that year 1 is 2018 or a later year. A. What are the year 2 tax consequences if P and S file a consolidated return? What are the year 2 tax consequences if they instead file separate returns? All right, so year 1, they were separate entities. And you can see that in year 1, P's taxable income was $40,000. S had a net operating loss of $29,000. In year 2, these corporations are now affiliated in filing a consolidated return. So in year 2, S brings in a net operating loss. Now we know that the affiliated group can't make use of that net operating loss until S makes a positive contribution to taxable income. So looking at year 2, S has done that, but what do we also see? We see that the consolidated taxable income is negative. So we can't use a carryover net operating loss because we have another net operating loss. So here, part A, if the affiliated group files a consolidated return, the group combines P's loss and S's $20,000 of income, resulting in a $10,000 consolidated net operating loss. The 80% limitation on the NOL deduction doesn't apply because we have a loss, so the group carries over the $10,000 net operating loss. And then S's year one NOL also cannot be used, so it continues to be carried forward. The PS group cannot use any of the year one NOL. But if they had filed separate returns now, you can see the results of their operations. S could have used a portion of its net operating loss, applying that 80% limitation rule here. So in year two, P carries over indefinitely its $30,000 loss, and S can deduct $16,000, which is 80% of the $20,000 of its taxable income of its year one net operating loss in year two, and then it continued to carry over the remaining $4,000. All right, part B, what are the year three tax consequences if P and S file consolidated returns for years 2 and 3? So in year 3, we have positive consolidated taxable income on a group basis of $27,000. So we know that that 80% limit is going to apply to the $27,000, and then we can deduct net operating losses based on that number. So finally, we can use that $29,000 loss from year 1, but again, we're going to be limited to 80% of the consolidated taxable income. So 80% of $27,000 is $21,600. So we will be able to deduct that amount of net operating loss, and we will carry forward the rest. So $21,600 of S's year 1 net operating loss is going to reduce year 3's consolidated taxable income to $5,400. And then the remaining net operating loss of $7,400 is going to carry over to year 4. When we have an investment in a subsidiary, we have to compute a basis, and we know it generally starts with what we paid for it, but we need to adjust that annually for the sub's profit and losses as well as its distribution to higher tier subsidiaries or its parent. So, like I said, the starting point for basis is the original basis of the stock investment. And then the amount is increased or decreased for the basis adjustments, and those common adjustments are found on page 8-31. But if we get a share of profits, we adjust our basis up. If we get losses, we adjust our basis down, things like that. If we receive distributions, we adjust our basis down.